last few weeks have seen a radical shift in the interest rate outlook in the US versus the UK. While the Bank of England cut rates by 25 basis points in August, they kept rates on hold at the September meeting and have suggested that any further cuts will be gradual. By contrast, the Fed cut by 50 basis points in September, and Jay Powell, the chairman, well, he's done very little to push against the market's view that hefty rate cuts are coming in the US. And this has been reflected in interest rates, which have moved significantly in favour of the UK. And this is supporting sterling and underpins my suggestion that it could head towards $1.50 in 2025. Now, of course, interest rates are not the only factor here. Sterling was appreciating versus the dollar and other major currencies earlier this year, even before the interest rate gap opened up. And that reflected improved UK growth prospects. These may suffer a bit as household energy bills rise by 10% this week. And the 4.4 million household on pay-as-you-go meters, well, they will see that impact immediately. Most of them are on lower incomes and their energy bills are double as a share of income than the national average. But 85% of households are not on pay-as-you-go meters, and they have higher incomes, and so they account for an even higher percentage of overall consumer spending. Indeed, my energy supplier has only allowed me to cut my direct debit recently to reflect lower prices earlier in the year, and many others will be in the same position. So my guess is the overall impact will be limited. Indeed, consumer confidence, that should bounce back over the budget later this month. The incoming Labour government have overdone the expectations management ahead of the budget on the 31st of October, and yes, taxes will rise, but they'll be focused on capital taxes with limited impact on most people, limited impact on demand. In addition, the housing market is recovering, which will further strengthen demand. Moreover, it seems likely that investment spending by the public sector and in conjunction with the private sector will emerge largely unscathed in the budget. Quite right too, in my opinion. Despite all the gloom and doom in the media, by the way, private investment has already been growing strongly in the UK so far this year, despite the weakness in demand in Europe. By far our biggest trading partner, our manufacturing sector has been doing relatively well. Now, don't get me wrong, this is no boom, but it's a much better outlook relative to expectations. The background in the US is, of course, also relevant here. To the currency, most members of the FOMC have decided that the war against inflation has been won there. Consumer price inflation will continue to fall as wage inflation subsides, along with areas like auto insurance, rents, and hospital bills, which are subject to regulatory and contractual delays. Growth looks good in terms of GDP, but the Fed, they're focused much more on the labour market. As we discussed in Market Perspectives in August, the US unemployment rate has breached something called the Psalm rule, which has indicated recession in the US with remarkable accuracy and timing. Now, most economists agree that it's different this time, but the Fed will certainly be acutely sensitive to any further labour market weakness, and the jobs data out this week will be crucial in this regard. Hard data are not the only factors relevant for sterling, but they're supportive too. The UK is seen as politically stable, especially in relative terms. Now, that's quite a change from the recent experience. Sterling is a risk-on currency, which means that it tends to strengthen when global equities are firm. We remain positive on the outlook, which would be supportive for sterling. What about the wider implications of a strong sterling? Well, at one level, it represents a terms of trade gain to UK citizens, and people will see this most obviously when they go on holiday abroad, but it also has a wider impact via lower import prices. Now, the counterpart is a bit of a struggle for exporters, but evidence suggests that this will not be a dramatic effect. UK equity investors, they could see more significant effect. FTSE 100 companies, their earnings are predominantly in dollars, and they'll see a straightforward translation loss on sterling strength. That may be attenuated in terms of the overall market if overseas investors buy more UK equities, and they're currently underweight. UK holders of global equities, they would suffer a straightforward decline if their holdings are unhedged. Now, forecasting currencies is a risky business, but I do think the next major move in sterling is up. We shall see. Till next week, goodbye.